In today's video, we are going to discuss premium deposit accounts. What is a premium deposit account? So a premium deposit account is an account where you can park money. It's positioned with the insurance company that you're taking your whole life insurance policy out with. And what happens is you park money with the insurance company. They apply a rate of return, an interest rate, to the money that you're parking with them in advance. And then what happens is that money, that account, funds your whole life insurance policy over a predetermined number of years. So typically you'll see people who have a large sum of money state, okay, I've got money in cash over here that I do not need or want access to over the next 5 years, say it's 10 years. So what I'll do is write a check, a one-time check to the insurance company. I position it with them. They pay me, call it 4 or 5% in interest. And every year when my premium payment comes due, the money is moved from the premium deposit account over to the life insurance policy. And as the cash value builds up in the life insurance policy, that money I do have access to. However, the money in the deposit account, I do not have access to it, not without penalty. So going back to that point I mentioned earlier, I've got to be certain that I don't need or want access to money that I'm going to move into this deposit account. So with that said, let's provide a bit more information on this along with some examples. So it is a good option to be aware of. Again, just to provide some summary here, what a prepaid account does is it allows you to park future payments with the insurance company that in turn fund your whole life insurance policy. And notice here I said future payments because you can elect to take out a prepaid account and have that money cover one, just the base premium, or you can have it cover one, the base premium, and also a PUA payment. So if your goal, for example, is to fund a policy at $100,000 per year, let's say for 5 years, that comes out to what? A total of $500,000. Now, if this was a design, the 1090 split, a minimum base premium, $10,000 toward the base, and then $90,000 toward PUAs, what would that look like? Rich cash value right out of the gates, year in and year out. So in this particular case, you could say, all right, that's $500,000 in. Let me write a check to the insurance company for the full $500,000. Now it would actually be less than $500K because we do have to account for the interest we're going to receive from the insurance company, and I'm going to show some specific examples. But we can write a check to them for the full 5 years in advance and just have it be done with. You could also do something like this. If you said, well, I'm not comfortable writing a check for the full amount because I want access to the money. So what I could do is say, all right, if I just want to cover the base premium, my goal is to fund a policy with the same $100K per year for 5 years. What you could do is, let's say you put in $50,000 to the prepaid account, or pay the base premium, the 5 years of the minimum premium upfront. So that way that's covered for the next 5 years. And then over the next 5 years, you can just throw money into the PUA rider, which does add some convenience because one can say, all right, the minimum's covered for the next 5 years, and I can literally just log on my portal, throw money into the policy anytime I want, provided you've got a life insurance company that has a flexible PUA rider, which the examples we're going to look at on the actual illustrations will be Guardian, which does have a very flexible PUA rider, most flexible among the major mutuals in my opinion. So let's continue on here and look at some other bullet points. So advantage is that you can park money with the insurance company, future payments, which then fund the life insurance policy. You can earn some interest here. You'll see where the rates are right now will range between 4 to 5%, and those will likely go up a little bit as the years pass. And like we've seen throughout history, eventually they'll come down a little bit. But whenever you pump money into a prepaid account, whatever the rate is, you can lock that in, which is nice. So if I have a 5% option, that can be locked in as long as the money's with the prepaid account and feeding the life insurance policy. I don't have to worry about it going down if rates go back down. Here's the added convenience. Auto pay. The prepaid account automatically feeds the life insurance policy for me. I don't have to worry about doing it every year. Here's a drawback in red. Cannot access money in the prepaid account without penalty. So if you have an entrepreneurial mindset, or you're in a position where you say, hey, I don't like the idea of tying money up because how I have built my business or my real estate portfolio has really been through liquidity, having access to capital for when opportunities come about, I can take advantage of them quickly. Moving money into a prepaid account can restrict that to a degree. So I do want to have awareness of that up front. Now, as the money moves from the prepaid account into the life insurance policy, whatever your cash value is in the actual whole life insurance product, you have access to that. We're going to look at an example very shortly. So the money is taxable as it's moved into the life insurance policy. So as money is moved from the prepaid account to the life insurance policy, what happens here, any of the gains are taxable to you as ordinary income. So again, we're going to look at a specific example in a couple minutes here. But while it's in the prepaid account, not taxable, tax deferred. But once it comes out, even though it's paid directly into the life insurance policy, it's still treated as if it's paid to you and the interest is taxable. The time period money is with the insurance company is important. So all companies who offer prepaid accounts, you will see different time periods with them. We've got an example here with Guardian, which is a company that offers a prepaid account. Not all companies do. If you look at Mass Mutual, they do not have a prepaid account available. What they use instead is a SPIA, that stands for a single premium immediate annuity, which is similar, but also different. It's not quite as attractive, not in my opinion, but it does have a purpose as well. We've seen that been used by individuals in the past. But if we were to look at this prepaid account, 1 through 4 years and then 5 years plus, what you'll see, and these are rates from October through November, so depending on when you're watching this, the rates could be drastically different. You've got 4% and then 5%. And I've seen these rates change a lot over the years as the interest rate environment has changed. So what this means, what this represents, is the number of years that you have money parked with the life insurance company in this prepaid account will determine the actual rate you receive. And what you can see, the longer that you are willing to leave money with them and not touch it, the greater the rate they're willing to credit you is. So what I want to hit on here is an important piece. Look at this. Over here, plan. 100K per year for 5 years. If you didn't have a premium deposit account, prepaid account, and said, I'm going to fund it at 100K per year, that'd be a total of $500,000. If you said, you know what, I like the 5-year fund because we design a policy and that comes out to be the most efficient on a guaranteed and non-guaranteed basis with the internal rate of return, again, specifically the whole life insurance policy, we select that 5-year option. If you deposit $500,000 with the insurance company to fund that policy for 5 years, how many years would your deposit be held with the insurance company? Would it be 5 years where you'd qualify for the 5%, or would it be 4 years? It'd be 4 years, and here's why. When you make a deposit, part of that deposit will be sent directly to the life insurance policy. So in a case like this, if it's a 5-year funding example, you send $500,000 in first, $100,000 is sent to the policy, and then the other $400,000 is deposited into the prepaid account, and then payments years 2 through 5 are moved from the prepaid account into the life insurance policy. Want to see some examples? Let's look at some actual numbers and illustrations here. This will be fun. So first we'll look at the detailed ledgers here. We've got 100K per year for 5 years in this example. So this will look familiar if you've seen any of our videos, right? So we've got a policy set up for maximum cash value. Here's the 100K per year, and this could be a policy where you're not using a prepaid account. You're just funding it at 100K per year. Here's your cash value, break even, year 5 right there. Year 4, you've paid in 400, you're at 390. Now this could also be a policy where you say, I only want to commit to the minimum. Base premium's 9,000 plus the term, the true minimum commitment will be 10 to 11K, and then add additional funds at discretion. You can do that. But what if this is the policy you want and you said, you know what? Can I just write you a check for the full $500,000 up front? The answer is yes. That's why companies make these prepaid accounts available. But at the same time, it's no with respect to not being able to get the full $500 into the policy. Got to move it into the prepaid account, which if you want access to that $500 before it's into the policy, you could have to deal with penalties and such. So let's take a look here. What we've got is a premium deposit account breakdown. And what we see here, how a prepayment works. I like how they explain things, this insurance company. They make it very simple. How a prepayment works. In year one, the first premium of $100,000 is paid. That first premium includes the base premium and all PUAs in this particular example. But that's paid, and then an additional $362 and change is held to pay future premiums at a discount. The discount rate is 4% for the entire period. And this particular period, this illustration, is based on 5 payments of $100,000 moved into the life insurance policy. So what we see here, year one total to pay 5 premiums. So if we wanted to get a net of $100,000 per year into the policy, a net of $500K, what we would need to do here, based on the 4% interest that will be applied to our money, is make that deposit of $462,990. And then what happens here, that deposit, so first $100 goes directly into the policy, and that's why here we see the other $362 and change is held with the premium deposit account. What happens then, so over here, we see the premium payments. This is money moved into the life insurance policy. And then here's your prepayment balance. So first year, $362,990. That's earning interest for that full year because you've deposited $100,000 into the policy. 12 months later, the next $100,000 will come due. And here's what we see. So before that next $100K payment, we see the interest earned. Then the next year, another $100,000 deposit is moved from the prepaid account over to the life insurance policy. Balance comes down. Here's the taxable income. We ran this at a 30% tax bracket. So based on the gains here, the taxable income, those are the taxes due. So we do have to be aware of the fact that if we use premium deposit accounts, we may have to deal with taxes. None of this is tax advice. Always consult your CPA or a tax attorney for anything tax related. All right. So here we get a disclosure of the taxes. And why don't we do this? So what we put together here is a simplified spreadsheet. This will make things a bit easier in my opinion. What we've got here is the exact same illustration. It just makes things a bit easier from, call it a transactional standpoint, at least for me. So what do we see here? On the left, we've got the initial deposit, right? Initial out of pocket. You write a check to the insurance company for $463,000. Of that check you write, $100,000 is sent directly to the policy, which means you have access to that almost $84,000 in this example. Now, what happens each year thereafter is money from the deposit account. I should have put that on this Excel sheet, but we just looked at it in the PDF. That is moved from the account into the policy each year. But what happens as the money is coming from the deposit account, we've got taxable income. And assuming we're in a 30% tax bracket, there's the actual taxes due each year. So what I'd want to know here is what's my net out of pocket. When I say net out of pocket, assuming the initial amount I sent to the insurance company, plus the taxes I have to pay each year. And we can put them on the Excel workbook. We could also go to the next page and look at that. So this will display this column right here. There's your first year deposit, plus the taxable amounts. So I paid in, accounting for taxes, $474, and I got $500 into the policy. Let's look at the same thing, but a 10-year fund. Because if we go back to our whiteboard, what happens here if we're funding it more than 5 years, 4 years or less was 4%. Here, it's 5%. You get a little bit higher rate. But what do I have to do? I have to leave the money positioned with the insurance company for a long period of time. Am I comfortable with doing that? That's the main question. So let's go back here and let's take a look. Let's actually first look at the illustration just to make sure everything is validated. And here we go. So similar policy. We had to design it a little bit differently in order to be able to handle 100K per year for 10 years. There's the funding, 1141. And as we take a look at this, let's go down and look at the same thing. Here we go. So funding for 10 years, 100K per year. How much is needed here? What's the initial deposit? Year one total, you pay 10 premiums. In order to get $1 million into the policy, how much do I need to write in the amount of a check to the insurance company? $810,000. That's going to be appealing to some people because I see a difference there of almost 200 grand. It's 190,000. However, before we just jump in and say, hey, look at that savings of 191, right? Or the total discount here is how they word it of 189 based on the 5% rate. Remember that one, taxes will be due, but here's the big thing. And even with this savings is gaining, call it $190,000 from the insurance company over 10 years, worth tying the money up for 10 years. Not all of it, because as it's moved into the policy, you will have access to it. However, a lot of entrepreneurs we work with, or people with an entrepreneurial mindset, will look at this and say, you know what? If I put it in here and a real estate opportunity comes up, or I can invest in my business where I know I can earn more than 5%, I don't know that I'm comfortable with it. Someone who is a cash cow, has a lot of money in cash and they're cash flowing from other investments and such, might look at this and have a different mindset. Just from the individuals I've worked with over the years, when someone's in a position, I remember one individual took out a premium deposit account, it was actually Mass Mutual SPIA, but it was the same approach. We looked at Mass and Guardian and he said, hey, got this big chunk of change. I'm not going to use it. Like I've got other investments, other assets. He did very well. He was in a good position and he was certain, it's like, I'm not going to use the money. I'd like to dedicate it for this. Sent in a large check and just has it fund the policy for a long period of time. So everyone's different, but I always like to make sure, are we comfortable positioning the money in here? Because when we look at this guy, if we scroll down a little bit, what do we see? There's the payments of $100,000 per year. Here's your prepayment balance. Okay, so what do I see here? That's the balance there. If I want to surrender it, I see the surrender penalty. Interest earned each year, not bad. Taxable income. And then, assuming a 30% tax bracket, the actual dollar amount I'll need to pay in income tax each year. And remember, this $100,000, I'm not getting it, it's going into the policy. So I've got that additional income tax of $6,500. Yes, I could borrow against the policy or just pay it if I've got the income to handle it, but I just want transparency on that. So let's take a look here at our Excel workbook and see the exact same thing. Pretty cool, right? There's the initial deposit. And what we can do here if we want, what we just looked at there. So let's take that balance there. Can't quite do it this way. Let's do it with the software. All right, so let's just export the balance right here. So there's your initial out of pocket, $810. $100 went directly to the policy. The other $710 was placed in the premium deposit account. Then each year, a net of $100,000 is moved from the deposit account into the life insurance policy. Why the balance is not decreasing by $100,000 per year is a result of the interest earned. So they do a beautiful job on the PDF. I don't even need the Excel workbook. I just like putting it there because I've got the policy values next to it, but there's the interest earned. So if I have 710, I add 35, then subtract 100, I'll come up with that 646 and change, which is exactly what's going on. So it's timed to be completed. after the 10th year, and money is moved into the policy. Now, one thing I will add here is for a premium deposit account, you can fund it anytime. If you've got an existing policy, you can decide, hey, I'd like to open this deposit account, have it feed perhaps the base premium or the policy for the next couple of years. So you don't have to feel like it's something where I'm first starting a policy, I got to choose if I want this account or not. No, you can do it anytime. And what I'll add is most people we work with do not elect to use these accounts. A few do, but most do not because they always want access to their capital. So as you weigh your options, if it might be a fit for you, we can always provide samples a lot like what you see up here so you can really make an informed decision. But as we look at it, we'll ask a lot of questions really to help you determine if it really makes sense or if you want the liquidity. And if it doesn't make sense now, but it makes sense 3 years down the road, you can always look at it then, and it can be with the same policy that's already in force. So I hope you enjoyed this video. I had a lot of fun with it. If you did, please hit the like button, subscribe for more. If you have any questions, please leave them in the comments below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.